361 Asset Management run a collection of domestic long-only and hedge funds, and in a short space of time have built up an enviable track record in the funds that they run. One of these funds is the 361 Met Equity Fund, and its primary objective is to generate sustainable capital growth for investors. Here to discuss the portfolio holdings is Daniel Isaacs, and of course you will be joining us in hot stocks as well, so you've got a lengthy television session on the go today. Daniel, let's start with your investment style.
Right. I'll just correct one thing quickly. In a short time period, we have actually been running for quite a few years. The 361 Flexible Opportunity Fund has a track record of over 7 years, in which we've managed to get net after fees 20% per annum growth. So short period.
Correction noted. Correction noted.
Not 2-3 years. Yeah.
Right. Yeah. So going back to your investment style.
Okay. So we are fundamental bottom-up stock pickers. We don't focus on the market as its own entity, what it's going to do, where it's going to go, what is the market going to do next year. We look at businesses, what they do, what the cost drivers are, what the markets that they are exposed to are, how they are valued based on what they can offer, and if they are attractive, we invest. If the analysis shows up an attractive opportunity, we invest in those businesses.
So Daniel, the stereotypes like growth investing and value investing, it's a little bit of both. I mean, you can't really nail it down, because you are able to look at companies, and we're going to discuss some of them now, that have great growth profiles, but they wouldn't be considered cheap by a value investor's standards. Is that the kind of approach that you'd use to sort of describe the portfolio?
Absolutely. We're not. I mean, we are value inclined, but we don't want to box ourselves into any specific category and not look at a great opportunity because it's not exactly value.
Okay, and just in terms of the margin of error, one of the things we've looked at, and I've been speaking with different value and growth investors for the benefit of our audience. Value is assessing very much what you can get in a share now in terms of the cash on the balance sheet, the earnings that the share has given you, whereas looking at growth is very much a look into the future and trying to assess what a company may be in 3 to 5 years based on growth in their revenues, growth in their profits. Is that the way you kind of think about it as well?
So, look, we like companies to generate cash and have all those good things. We're not into 40 times listing IT companies with no cash flow.
Sure.
But once again, we don't like to compartmentalize things and say this is a value company, this is a growth company. We look at a company in its own right. If it has certain things, if it has cash flow, we like that. If it doesn't have as much cash flow as we'd like, but it's got great growth potential, we'd continue to look at it. If the growth potential was significant enough, we'd invest in it. So once again, we wouldn't compartmentalize ourselves to say these are the markers that equal value, therefore that's value, that's growth.
Looking at a couple of the stocks and the top holdings in the Met Equity Fund, let's start with Naspers, because I think it meets a number of the criteria you're highlighting right now.
Right. So Naspers on a PE multiple, some would say looks quite expensive. The thing with Naspers is that you have to value it on a net asset value basis, or more of a sum of the parts, because their biggest asset is a holding in Tencent, which is the largest internet company in China. Now, the growth in that market for that asset is phenomenal. It's not like some of the other companies that are exposed to China, for example, SAB. All respect to SAB, we hold them in the portfolio, but for them to say we're exposed to China, it doesn't really feature on their earnings. Tencent it's the biggest player, and it's still growing. It's still growing significantly. So to be exposed to that market it's basically an asset that you cannot get your hands on. I mean, we know what it's like for foreigners to go into China to get a big piece of that market. I mean, you can imagine a business now trying to do that. Naspers gives you that opportunity now. Plus, they have other internet assets like Mail.ru, which is based in Russia. Those are all continuing to grow. They have their local assets, which is MultiChoice.
At 548, do you still feel that this is a sure bet?
I still feel that there's value, medium to long term, absolutely.
Just in terms of that, this is an interesting company, Naspers. It's got a collection of businesses. You've alluded to this Tencent, which is one of the biggest components of earnings in the company. That's very much a growth business. And what sort of multiple is that business trading at?
So I'll tell you something interesting. That business is trading, if I'm not mistaken, similar or less than Shoprite. So the biggest internet company in China is trading similar forward multiples to Shoprite.
Well,
now Shoprite's a fantastic business, But just think about those concepts next to each other.
Well, yes, thinking about them, Warren, perhaps we move on to one of the other stocks that we should focus on, and that being Netcare, very much in the healthcare space. Richard Friedland, we know they've got some issues on debt, specifically debt out of the UK. Perhaps you can take me through those and allay any fears that investors may have.
So that issue with the UK is hanging over the valuation currently, because the South African operations performed well. And looking at the South African valuations and giving the UK a zero value, the stock still looks cheap relative to the other healthcare operators. I'm not saying it should be trading on the same level as those operators. We do also hold Life Healthcare, which is the best, in our opinion, the best operator in that space. But Netcare at the current price is not factoring in. I think there is too much negativity from the UK side being factored into that price. So that creates a buying opportunity. The issue with the UK is that the debt needs to be discussed before September 2013. What's actually going to happen to that debt? The debt sits in there's PropCo and there's OpCo. OpCo is where the leases for the hospitals are, and then there's PropCo where the debt sits. Now, according to Netcare, they can walk away from the PropCo debt and have no recourse, right? So obviously the market is either worried about reputational risk from them walking away, or not entirely believing them that there will be absolutely no recourse to them. But we think that it's more likely a suitable agreement will be arranged before that date, because Netcare is in a very good bargaining position due to how the debt agreements are structured. And once again, like I said, the local operations are actually doing nicely, and they are not priced for what they are worth.
Daniel, the debt that sits on the balance sheet in the PropCo, in the companies that own the properties that the hospitals are based on, is that listed debt, or is that debt that's been syndicated to banks?
That debt is ring-fenced. As far as I know, the OpCo debt is listed, and Netcare has been actually buying that debt, and it's actually been revenue accretive for them. The PropCo debt, I'm not 100% sure.
Okay, so that's where the bulk of the debt, when we talk about the debt that Netcare have on balance sheet.
Right, it sits there, and they're in the position to walk away from that. That's not going to affect the OpCo operations, and they can carry on running their hospitals as if nothing happened.
So at this point, you still feel that these issues have perhaps been over affected the share, or affected the share, exaggerated the discount in the share, and are you still finding value in the share at these levels?
Yeah, absolutely. I mean, just looking at the South African operations and what they're going to do, it's trading on a forward multiple relatively cheap in the healthcare space. I mean, if you consider that Mediclinic and Netcare are trading close to 20, maybe even over 20, I'm not saying that Netcare should trade on the same multiples as Life Healthcare, like I said previously. But to be trading on a 12 versus a 20, there's a bit too much discount there.
Daniel, we had the analyst on last week talking about these health companies, and they've all pursued these expansion strategies overseas in different forms. Life has gone to different areas, Mediclinic's gone to the UAE, and we've got Netcare in the UK. Which one of the three have you just from a strategic point of view, which of those three do you think is best executed their offshore expansion?
So look, I mean, obviously the UK has been a bit of an issue for Netcare. That's more of a global issue. Obviously things in the UK are getting tough. The issue in Switzerland is quite interesting, because they've gone under quite a few regulatory changes. Again, something that can't be controlled by Mediclinic, where hospitals are moving into specific cantons, which are geographies. They are then subject to specific billing criteria that Mediclinic now has to gear up for and get used to and price for. Life Healthcare has moved into India, sort of tipping their toes in the water. In terms of execution, the issues that have happened are more top-down, right? UK falling out of bed, Switzerland regulatory issues. So I don't think you can specifically fault the companies themselves.
Okay.
And then just a final one on Richemont. Pretty much the same story as in Naspers. This one just keeps going up.
Right. Well, I mean, it took quite a knock recently. People watch the monthly Swatch numbers very closely. And as always, one data point does not make a series. So when one of the more recent months came out with quite a negative number, the stock took quite a knock, I think, down to 50. I think it's now trading close to 67, 68. We picked up quite a bit of stock in that drop.
So a high level of conviction on your front.
It's still a fantastic company. It's exposed to a resilient consumer. You are still going to buy those expensive watches, especially in China. You know, China has a very strong gifting culture that revolves around, you know, sort of expensive items like these watches. You know, that's a strong underpin. So we are still very happy with that stock.